following content is an update and technical analysis on silver futures based upon the daily interval, in which I will additionally dive into the outer layer within the monthly time frame. And on the 2nd of December 2023, we were trading spot price 25,499, and I had remained how critical it was. We were gearing up towards a major reactionary downtrend line, call it a multi-major reactionary high price resistance in confluence of the 382 monthly interval Fibonacci retracement. And it was a dual key inflection point, dual transitioning point, in which it favored a great risk reward ratio short trade setup to the downside, and a reflection in which long traders and or bull traders wanted to see a solid breakout with conviction on a infused green solid candle close up above, whereas short sellers, bear traders, they wanted to see a solid rejection amongst that dual price of resistance, honing in on to the 25.43 price support, second target 24.53, and then ultimately the 23.850, in correlation of the 50-day moving average if and when we go on to refill and have a complete backfill of the gap. And here's the update. In the entirety of that trade, based upon the 382 fibs retracement, trade was good for, call it a 11.3% crash. And I believe we've reached an additional key inflection point based upon the outer layers within the monthly time frame. As of now, we have confirmed crossovers here in the moving average convergence, the beginning stages of testing its zero line threshold, as the oscillator is still above its zero line threshold, where it has been just a very violent move to the downside and currently undercutting the 50-day moving average. And upon zooming you out to the monthly time frame, based upon the 382 fibs retracement and the primary reactionary downtrend line off the 2011 major reactionary highs, was met with a very key violent inflection point that was rejected upon off the 382 fibs retracement, and the outer layers of the primary downtrend line in the monthly time frame offered the most valuable risk reward short trade setup to the downside. And here we are about to revisit a major reactionary low uptrend line of price support based upon the 2020 April reactionary lows, and I believe this would offer the utmost risk reward setup to the long side, where long traders and or bull traders need to heavily defend this key inflection point if and when we come across this key pivotal inflection point, which will be correlated around the 2220, call it 2220-ish range. And it would need to be defended heavily at all costs for any long traders and or bull traders to re-challenge what you would call the primary downtrend line in the 382 fibs retracement. Short sellers, bear traders, they want to see a solid monthly infused candle close breakdown sell signal below that key inflection point to go on to re-challenge the 236 fibs retracement, call it 2051 price support, in which will correlate with the 200-month moving average, call it a dual transitioning point of price support there. And that would be an ideal first primary target if and when we go on to snap that key juncture. And what will transpire with taking out that key transitioning point is you will have breakdowns, multiple momentum indicator zero line thresholds upon the moving average convergence, and then ultimately the price percent oscillator.